Welcome back. I'm Tamana, and today we're diving into the world of trading, a path full of opportunity, but also hidden pitfalls. Trading can be rewarding, but the line between success and failure is razor thin, often defined by avoidable mistakes. The good news? You don't have to repeat the errors of countless traders before you. By understanding these common traps, you can build a solid foundation and protect your capital. In this video, we'll break down the top 10 trading mistakes you must avoid and how to sidestep them for long-term success. Grab a notebook. Let's get started on trading smarter, not harder. What's the single biggest pitfall that trips up aspiring traders? It's trading without a plan. Jumping in headfirst without a clear strategy is like navigating a minefield blindfolded. Imagine building a house with no blueprint, no architectural design, no structural engineering. The result? Inevitable chaos. A jumbled mess of materials and wasted effort. A trading plan is your written rulebook, your personalized roadmap to navigate the markets. It's a comprehensive document outlining your financial goals, your risk tolerance, the amount of risk you are willing to undertake. It also includes your specific entry and exit criteria for trades and the strategies you'll employ to achieve your objectives. Without it, you're trading on impulse, driven by fleeting emotions rather than sound logic and analysis, and emotional decisions. Like chasing a soaring stock, caught up in the fear of missing out, or panic selling during a market dip, driven by fear and uncertainty, are a recipe for disaster, turning your trading account into a high-stakes gamble. Your plan should detail exactly when to enter and exit trades based on predefined signals and indicators, and how much you're willing to risk on each trade, protecting your capital from significant losses. It's not just about what to trade, which stocks or assets catch your eye, but how and why you're trading them, providing a clear rationale for every decision. Treat your plan as a living document, constantly evolving with your experience and market conditions. Review and refine it regularly, analyzing your past trades to identify areas for improvement. But never ignore it in the heat of the moment, when emotions run high and discipline is most crucial. Trading without a plan is gambling, plain and simple. It's not a sustainable path to success in the markets. Luck isn't a strategy, it's a fleeting illusion. Preparation is the cornerstone of consistent profitability. Write out your plan meticulously, leaving no room for ambiguity. Define your motivation for trading, understanding what drives you to participate in the markets. Set realistic expectations for your returns, avoiding the trap of unrealistic profit targets, and stick to your rules, even when it's tempting to deviate from your plan. Take this seriously, commit to the process, and you'll be ahead of most traders who treat the market like a casino. Next, and this is crucial, never risk money you can't afford to lose. This is a fundamental principle of responsible trading. Only trade with truly disposable income. Think of it as money allocated specifically for entertainment or speculative ventures. Never your rent money, your emergency fund, or any funds earmarked for essential living expenses, or borrowed money. Trading with borrowed funds amplifies both potential gains and potential losses, creating unnecessary financial strain. Trading with scared money inevitably leads to poor decisions. When your capital is tied to essential needs, fear takes over. Fear and desperation cloud your judgment, leading to impulsive actions and ultimately greater losses. If a loss would significantly impact your daily life, causing undue stress and anxiety, you'll be tempted to break your own rules, chasing losses and deviating from your carefully planned strategy. Professional traders understand this implicitly and focus on capital preservation first and foremost. Profits come second. Protecting your trading capital is the foundation for long-term success. Therefore, before funding your account, take a moment for careful consideration. Decide realistically how much you can truly set aside for trading without jeopardizing your financial well-being. Stick religiously to the 1 to 2% rule. This is a cornerstone of sound risk management. Never under any circumstances risk more than 1 to 2% of your total account balance on a single trade. This disciplined approach keeps individual losses manageable and prevents catastrophic drawdowns. And crucially, it helps keep your emotions in check, allowing for rational decision-making. Remember, surviving and thriving in trading ultimately means protecting your capital above all else. If you blow up your trading account through reckless risk-taking, you're effectively out of the game, unable to participate in future opportunities. Therefore, only risk what you can realistically afford to lose without impacting your financial stability, and you'll be able to trade with a clear, objective mindset, free from the crippling effects of fear and desperation. Ignoring stop losses It's a gamble with potentially devastating consequences. Many new traders, eager to jump into the market, often overlook the critical importance of these protective measures. They see stop losses as an admission of defeat, a sign that their trade idea was wrong. Is a fast track to disaster. It's like driving a car without brakes, hoping you'll never need them. But in the unpredictable world of trading, you absolutely will. The market doesn't care about your hopes or dreams. It only reacts to supply and demand. A stop loss is your safety net, your predetermined exit point. It's the level at which you say, okay, this trade isn't working out as planned, and I'm cutting my losses. It limits your loss and protects your account. Think of it as a circuit breaker, preventing a small problem from turning into a catastrophic meltdown. Without it, you're exposing yourself to unlimited downside risk. Many traders avoid stops, often paralyzed by the fear of being stopped out prematurely. They think, what if the price bounces right back up after I sell? Hoping a losing trade will turn around. They hold on, watching their losses mount, clinging to the hope that the market will magically reverse direction. Sometimes it does, and they feel vindicated, reinforcing their bad habit. But often it doesn't. More often than not, the market continues its downward spiral, and their small loss becomes a much larger one. One trade without a stop, left unchecked and allowed to run wild, can erase weeks of gains. All the hard work, the careful analysis, the winning trades, all wiped out by a single act of negligence. Hope isn't a strategy. It's a recipe for disaster in the markets. Discipline is. Discipline to stick to your plan, to manage your risk, and to exit a losing trade when your stop loss is hit. Place your stop loss order immediately after entering a trade. Based on your plan and technical analysis, don't just pick a random number. Your stop loss should have a logical basis. Below support, giving the price some room to breathe, but not so much that it exposes you to excessive risk. Beyond a moving average, which can act as a dynamic level of support or resistance, or wherever your thesis is invalidated. This is the most crucial point, where you know your initial idea was simply wrong. Once set, and the trade is live, never move your stop further away to avoid a loss. This is a cardinal sin of trading. That's just redefining your pain point, and digging yourself into a deeper hole, and inviting bigger losses. It's a slippery slope that can quickly lead to financial ruin. Think of stop losses as insurance for your trading capital. You hope not to use them because that means your trade didn't work out. But you'd be foolish to trade without them. It's better to have insurance and not need it than to need it and not have it. Knowing your risk before entering a trade by determining where your stop loss will be allows for proper position sizing. You can then calculate how much of your capital you're willing to risk on that particular trade. Survive to trade another day, that's the ultimate goal. By always using stop losses, it's the cornerstone of responsible risk management. Don't let one bad trade wipe you out and destroy your trading career before it even begins. Make stop losses non-negotiable. Treat them as an essential part of your trading process, not an optional extra. Overtrading is a common trap trading too often or with too much size. Many think constant action equals success, but real profits come from patience. Overtrading often means taking low-quality setups or trading out of boredom, not strategy. Sometimes the best move is to do nothing and wait for a high-probability setup. Revenge trading, jumping back in after a loss to win it back, is especially dangerous. This emotional spiral can quickly blow up your account. If you take a tough loss, step away and reset. Set strict rules, limit your trades per day, and cap your daily loss. Treat your capital like a sniper's ammo. Wait for the perfect shot. Don't waste it on low-probability trades. Discipline and patience are your best weapons. Trade less, but trade better. Emotions, fear and greed are the root of most trading mistakes. Greed makes you overstay winners or over-leverage after a few wins. Fear makes you exit good trades too early or avoid valid setups after a loss. This emotional cycle leads to impulsive, destructive decisions. The solution? Rely on your trading plan, not your feelings. Use stop losses to manage fear and set profit targets to control greed. Keep a trading journal to track your emotional state and spot patterns. Practice self-awareness. Recognize when emotions are taking over. Step back when you feel overwhelmed. Trading is a mental game. Master yourself to master the market. Don't blindly follow tips from social media or influencers. No one cares about your money more than you do. Proper research means developing your own thesis for every trade. For technical traders, analyze trends, support, resistance, and indicators. For fundamentals, understand the business, financials, and market context. Doing your own homework gives you an edge and builds conviction. When you know why you're in a trade, you're less likely to panic on volatility. Informed decisions beat herd mentality every time. Build your own perspective. Don't outsource your responsibility. Research is your shield against costly mistakes. Chasing losses, trying to win back money right after a loss leads to disaster. It's a gambler's mindset, not a trader's. When you let your last trade dictate your next move, you abandon your plan and take on too much risk. The market doesn't owe you a win. Chasing losses often leads to bigger losses and emotional spirals. Treat every trade as independent. The outcome of one doesn't affect the next. After a loss, pause, review, and wait for your next valid setup. Set a daily max loss rule. If you hit it, stop trading for the day. This circuit breaker protects you from emotional blowups. Accept losses as part of the business. Control them, don't let them control you. Skipping a trading journal is a huge missed opportunity. A journal is your personal performance review, your tool for improvement. Record more than just entry and exit. Log your reasoning, emotions, and execution. Be brutally honest. This is for your eyes only. Over time, you'll spot patterns in your behavior and results. Maybe you lose more on certain days or break rules after a win. Use this data to refine your strategy and fix weaknesses. Journaling turns trading into a process of continuous improvement. It's not glamorous, but it's essential for long-term success. The best traders are diligent journal keepers. Putting all your eggs in one basket is risky. Never go all in on a single trade or asset. The market is unpredictable. Even the best setups can fail. Use the 1 to 2% rule to spread risk across multiple trades. Diversify your portfolio. Don't concentrate all your capital in one asset class. True diversification means mixing stocks, bonds, real estate, and more. Within stocks, own shares across sectors and industries. This cushions you from sector-specific disasters. Even in active trading, diversify across different assets or markets. Don't let one event wipe you out. Spread your risk, protect your capital, and build resilience. Diversification is your safety net. Trading in a vacuum, ignoring news and events is dangerous. Major economic releases and unexpected news can cause wild market swings. Always check the economic calendar and know when key data is released. Many pros close positions before high-impact news to avoid unpredictable volatility. Beyond scheduled events, stay alert for unscheduled news, politics, disasters, earnings reports. Use a reliable news feed as part of your setup. Technicals show structure, but news provides context and catalysts. Ignoring news is trading with one eye closed. Stay informed to avoid landmines and seize opportunities. Protect your capital by being aware, not surprised. Those are the top 10 trading mistakes to avoid on your path to profitability. Success isn't about secret formulas. It's about discipline, risk management, and learning from these pitfalls. If you found this helpful, hit like and subscribe for more trading insights. Share your biggest trading mistake or best tip in the comments. Let's learn together. Trading can be lonely, but our community is here to support you. Thanks for watching. Stay disciplined and see you in the next video.